Alrighty, y'all. Thursday Q&A, so I do apologize for getting this posted a little bit later than usual. It's about, 10 o'clock on my end, but no excuses. We got to get it posted, and we do got a couple of good questions here, so I appreciate y'all for posting these here last week. Here's a question I really want to focus on in this week's Q&A. From 1,000 Memories, my question for next week is, I noticed that you use a lot of credit spreads in your trading strategy. Under what scenarios would you swap those for directional trades? Long calls, debit spreads, things of that nature. So great question. Let's talk a little bit about, first and foremost, why do I trade credit spreads so much? Why is that my weapon of choice? And then I guess we can discuss a little bit about, when would I opt for, buying straight up calls or using a debit spread? So, in regards to why am I such a big fan of the put credit spreads? Let's take a look here at Amazon's weekly squeeze. So, for the sake of this conversation, let's come to agreement that we found a setup here that we think over the next 30 to 60 days has the potential of going higher. So typically what you're going to get in this kind of scenario, is traders doing one of two things. You're going to have traders buying calls, whether they be in the money or out the money. Then you're going to have traders more so like me who are going to sell a put credit spread. So, I found a beautiful setup here. I think over the next 60 or so days, this has a damn good chance of trading higher, but I'm going to sell a put credit spread just to put the odds in my favor. So if I look at the options chain here, so for April 16th expiration, 57 days out, I sold the put credit spread today actually, selling the 3150 puts and then buying the 3100s. So basically here, you can take my trade with the credit spread. All that I need Amazon to do over the next 60 days is to hold above 3150, and I'm going to walk away with a profit. And I've made a good chunk of profit on Amazon and Nvidia this year simply by collecting premium with the credit spreads through the passage of time. Amazon is my biggest winner here so far this year, simply just from getting paid on a weekly basis, collecting that out the money premium. If you had been holding naked calls here inside this Amazon squeeze, pursuing that move to the upside, because it's been a total chop fest, you're getting crushed by premium decay. Where for me being the option seller in this instance, the premium decay is working in my favor. So, I think we need to take that into consideration when we're having that discussion of selling credit spreads versus buying options. If trader A buys calls here inside this Amazon weekly squeeze, there's only one move that's going to lead to, a profit for that trader. And of course, that would be Amazon moving to the upside. Should Amazon slowly grind higher, they might make a little bit. They might lose a lot, depending on their strike selection. Should Amazon continue to squeeze in the weekly time frame, if you're holding those naked calls, if you bought those calls outright, you're getting crushed by premium decay. And of course, if Amazon rolls over a little bit, you're in tough shape. With the put credit spread, and selling that short strike at 3150, over the next 60 days, if Amazon does explode higher, I'm going to collect my max profit. If over the next 60 days, Amazon just chops back and forth, but slowly grinds its way higher, I'm going to collect my max profit. If Amazon just continues to go completely sideways for the next 60 days, I'm going to collect my max profit. If Amazon is trading a little bit lower 60 days from now, I'm going to walk away with my max profit. As much as I think we have a bullish structure here, and as confident as I am that Amazon is going to go higher over the next 60 days, all I need here to make my profit, and mind you, I got about a 2-to-1 risk-reward ratio. So on this trade, I'm risking about $14,000 to make $6,500. All I need to make that $6,500 is for Amazon to just close above $3,150 come expiration. So I found a stock within a strong market in a weekly squeeze, and I'm really confident this move can lead, towards the upside. But I'm going to place a bet that it's not going to move $200+ in the opposite direction. And as long as it doesn't do that, I'm walking away with my nice premium. So that's a little bit of insight as to why do I focus on selling the credit spreads. There's just, there's so many more outcomes where you can walk away with a profit, and premium decay is working in your favor. So for me, that's what I found to work best. Now, to answer your question, when would I opt to buy, in the money, out the money calls? When would I opt to do a debit spread? It would be on the same exact structure. I think the best time to get long as far as being an options trader is inside of a squeeze on a trending stock. So whether it be the weekly, the 3-day, the daily, a 4-hour, a 1-hour, I think for credit spreads, for debit spreads, for buying options outright, the squeeze is the moment in time where there's a growing probability you're going to get a pretty damn nice move. Not a guarantee, but we're thinking in terms of probabilities. This is really important when it comes to buying out options outright. Right now on a weekly time frame, Amazon is just chopping back and forth. In the midst of this chop, though, there's a growing probability that sometime soon we're going to release all this energy and Amazon is going to make a bigger than expected move. The market makers aren't, taking into consideration right now the potential for that explosive move. It's not being priced in. So from that standpoint, though they're very pricey right out of the gate here, being Amazon, these calls are potentially undervalued. And should Amazon begin to release all that energy to the upside, those calls quickly can gain some value. So for me, it's all about the setup and it's all about the probabilities. If you're looking to trade options long, whether you want to sell a put credit spread, buy calls, buy a call debit spread, I think the first place to focus is the setup itself. And a daily, a weekly, a 3-day squeeze, a squeeze of any time frame really, is just that high probability moment in time where there's a damn good chance you're going to get that directional move. So that's when I would focus on switching it up. I'm going to stick with my credit spreads, but if I were to buy options outright or focus on debit spreads, it would be the same process, the same strategy, and the same structure of looking for those bullish looking squeezes. And the last one I'll cover here is from Lauren. I would love the answer to this question as well, which I just gave you all there. And would also like your opinion on call credit spreads versus put credit spreads. Will you take the call credit spreads and the histogram is in a squeeze showing red momentum and the stock is at the 21? I know it's a trending bull market, but I'm trying to have a little bit more diversity. So, awesome question, Lauren. And if I'm looking to trade something to the downside, I'm going to focus on a very similar structure. And you're correct. Under the 21 EMA, in a squeeze, whether it be a daily, a lower time frame, bearish momentum on the histogram, and ideally the moving averages stacked negatively. So I'm still going to look for the same probabilities as far as the setup goes, the buildup of energy, and then just structurally looking for things potentially leaning towards the downside. Now, to be transparent with you, I'm not focusing on a lot of short trades in this environment. And if I look at all my trades over the last year, a very small handful of them have been shorts. And it's just due to the nature of the overall market environment here. But I would be still looking for squeezes. And another thing you can take a look in for potential trades, and this isn't always easy, but if we think about the concept of reversion to the mean, even in the midst of a very strong market, stocks are going to move too far away from the 21, which is typically 2 to 3 ATRs, and then you're going to get the reversion back down to the 21. So maybe NVIDIA here isn't the best example, but I think if you're looking for shorts in the midst of a very bullish market, you can look for those squeezes, looking for them to fire to the downside. You can also try to play the market to the downside on the reversion to the mean. Natural ebbs and flows of the market, we push a good 2 to 3 ATRs off the 21, and you're going to see exhaustion coming in and things breaking down on lower time frames, which typically leads to a move to the 21. If you're quick enough, you can look to short that reversion back to the mean, but do respect the fact it's a bullish market, and more often than not, we're going to hold up here at the mean and then just turn the corner and keep on pumping higher. So only a couple questions this week, but I think 2 good questions, and hopefully that provides you all with some value. If you'd like me to answer anything next week, go on ahead and comment it below. You can comment it on Instagram as well, so follow me there at Focus Trades. And if you're not already, go on ahead and subscribe. And be sure to check us out at simplertrading.com. Check out Simpler Trading here on YouTube and Twitter as well. And until then, I'll talk to y'all soon, and we'll have the weekly recap video out tomorrow evening. Be safe. Peace out.